serious, cinematic, documentary tone. There's a moment that keeps returning in financial history like a recurring nightmare. A moment when numbers stop being lines on a chart and start becoming layoffs, bankruptcies, and families losing everything. When leverage, the same leverage that made people feel like geniuses on the way up, turns into a machine designed to liquidate them on the way down. It happened in 1929, when 89% of the U.S. stock market's value vanished in less than 3 years. It happened in Japan in 1989, when the Nikkei hit its all-time high and then spent decades sinking into a plateau it has still never truly escaped. It happened globally in 2008, when the banking system came within hours of full cardiac arrest. And every time, the people living inside the boom truly believed they were different. They had better models, new technology, smarter central banks, more sophisticated policies. They thought the old rules had been upgraded. They were wrong. Because what destroys markets is almost never a mysterious external shock. It's arithmetic. A 7-stage pattern that starts quietly and then unfolds with mechanical precision once enough leverage, belief, and bad incentives have piled up. And right now, in 2025, that pattern is not hypothetical. We're standing inside Stage 5, the same stage that in 1929 led to catastrophe within roughly 18 months. This is not prophecy, it's pattern recognition. And once you see the pattern, it's almost impossible to unsee it. Back to the beginning, 1920, when the fuse was lit. Let's rewind. The year is 1920. World War I has just ended. Europe is shattered, its cities rebuilt on debt and rubble. For the first time in its history, America is not the borrower. It's the creditor. European governments owe billions to American banks. U.S. factories that had been churning out shells, rifles, trucks, and uniforms now face peacetime. The industrial machine is still humming, it just doesn't have enough customers. Meanwhile, a new institution sits in Washington, barely 7 years old. The Federal Reserve, created in 1913, still fumbling with the controls to the most powerful machine of all, the money supply. The post-war boom sputters. In 1920-21, the U.S. economy is hit by a sharp but brutal recession. Factories slash shifts and close entire lines. Unemployment spikes. Commodity prices collapse. Grain, cotton, copper, everything drops. It's painful and fast. And then the Fed decides to intervene. They choose the lever that will define the decade: cheap money. Interest rates are cut, hard. By 1924, the Fed's discount rate slides down to about 3%. Commercial banks get the message. They start lending, aggressively. Mortgages expand, installment credit spreads. Suddenly, an average household can buy a car, a refrigerator, a radio, not after years of saving, but with a signature. For the first time in American history, mass consumption no longer requires accumulated savings. You can have the future now and let your future self deal with the bill. It feels like progress, but underneath, something deeper is shifting. When cheap credit rewires human behavior. There's a quiet psychological line that gets crossed when credit becomes too cheap for too long. People stop asking, "Can I afford this?" They start asking, "Can I get approved for this?" Why tie up capital in slow, productive projects that pay off over years when you can borrow cheaply and chase assets that double in months? Why save when borrowing feels painless? The entire incentive structure of the economy tilts, from production to speculation, from saving to borrowing, from patience to leverage. By 1925, that tilt is visible everywhere. Stock prices are drifting higher, not yet manic, but steadily enough that ordinary people, who used to read stock quotes like they were written in another language, begin to pay attention. At barbershops, in offices, on train platforms, the same questions start circulating. How are all these people getting rich in the market, and why am I not? And that's when they're introduced to the real accelerant of the 1920s, something called buying on margin. Stage 1. The weaponization of credit. Margin lending is the original financial weapon of mass destruction. Here's how it worked in the 1920s. You walk into a brokerage with $1,000. The broker smiles and says, "Why stop at $1,000? Put that down as collateral and I'll lend you $9,000 more." Now you control $10,000 worth of stock. If that stock rises 20%, your position becomes $12,000. You don't just make 20%, you turn your $1,000 into $3,000, a 200% return, on paper. All you did was borrow. The upside is obvious, the risk is not. Because if your $10,000 position falls just 10%, it drops to $9,000. You still owe your broker roughly $9,000 plus interest. Your entire stake is gone. If the price keeps falling, you don't just lose your money, you owe money. At that point, the broker doesn't ask politely, they issue a margin call. Deposit more funds now, or they will sell your shares immediately at whatever the market will pay. By 1927, this engine is roaring. Margin debt explodes from about $1 billion in 1921 to more than $8 billion by 1929, an 800% increase. To understand how wild that is, zoom out. $8 billion is roughly 8% of America's entire GDP at the time. Imagine today, when U.S. GDP is around $28 trillion, having over $2.2 trillion borrowed just to buy stocks. That's the scale of leverage the system was sitting on. And it didn't stop there. Investors borrowed from brokers. Brokers borrowed from banks, banks borrowed from other banks, and also from shadow lenders who scraped together cash wherever they could find it. Layer upon layer, the entire financial system turned into a tower of IOUs. Each floor balanced perilously on the assumption that the floor beneath it would never crack. The call money market, renting dynamite overnight. Now add one more explosive ingredient. In the late 1920s, there's a strange corner of Wall Street called the call money market. Essentially, the place where brokers borrow the money they need to lend to their margin clients. During 1928 and early 1929, interest rates in this market spike to 12%, 15%, sometimes 20% for overnight loans. Think about the psychology behind that. Brokers are willing to pay 20% interest to borrow money for a single day because they can immediately flip that money to speculators at even higher rates. And those speculators will eagerly accept the terms because their stocks are rising 30%, 40%, 50% a year. This is bubble logic in its purest form. Borrow at any cost because for now the returns exceed any cost. And it's not just banks and brokers playing this game. Industrial corporations, companies that make steel, cars, machines, begin to look at their cash reserves and think, why leave this sitting in the bank at 3% when we can lend it into the call money market at 10 to 15%? So they do. By 1929, major companies are quietly acting like shadow banks, diverting working capital that should fund inventory, wages, and equipment into overnight loans powering stock speculation. This is stage one in its purest form. Easy credit masquerading as prosperity. Not real, durable growth, not long-term productive investment. A financial carnival, financed by leverage, where everyone borrows to speculate and calls the rising numbers on their brokerage statements wealth. Stage 2, when speculation becomes a national hobby. You can see the shift right in the data. From 1925 to 1929, the Dow Jones Industrial Average climbs from around 100 to 381, a 281% gain in 4 years. Corporate earnings? Maybe 30%. Dividends? Modest increases. The rest of the move is pure multiple expansion. People paying more and more dollars for each dollar of earnings simply because they believe prices will keep rising. But here's the dangerous part. In the moment, it does not feel insane. In 1925, America looks like the future. Factories roar with output. Cities hum with electricity. New technologies, radio, automobiles, electric appliances are transforming everyday life. Henry Ford's assembly lines are rewriting manufacturing itself. General Electric is spreading light and power. RCA is turning radio into the internet of its age. Serious, cinematic, documentary tone. The productivity gains are real. The optimism is real. What isn't real is the gap between economic reality and financial pricing. Stocks are no longer just reflecting the economy, they're outrunning it. And that gap, that disconnect between what businesses earn and what investors are willing to pay, is where the danger quietly gathers. Because sooner or later, prices and reality always reconnect. And they never reconnect gently. By 1927, the story takes a sharper turn. The Fed, looking at a market that keeps climbing while consumer inflation stays tame, decides, once again, to lean on the cheap money lever. They cut the discount rate from 4% to 3.5%, partly to help Europe, still struggling under war debts and repair bills, partly because under the gold standard, high U.S. rates sucked gold out of Britain and Germany, threatening their reserves. So, in the name of international stability, the Fed eases. And in doing so, it pours gasoline on a market already drifting toward mania. 1928 becomes the year speculation turns from a hobby to obsession. Newspapers print market pages like sports scores. Radio shows explain surefire strategies. Teachers, machinists, clerks, and shopkeepers open brokerage accounts for the first time. Everyone knows someone who made a killing in the market. And then Wall Street builds a new product to meet the demand: the investment trust. Mutual funds with nitroglycerin inside. We'll step into that part of the story next, because once the trusts arrive, the bubble stops being big and starts becoming fragile. Serious, cinematic, documentary tone. Investment trusts looked harmless from the outside. They were marketed as the smart way to invest, a way for ordinary Americans to own a diversified basket of stocks managed by professionals. But beneath the glossy brochures and patriotic newspaper ads, these trusts were loaded with leverage. Not a little leverage, not prudent leverage, unhinged leverage. Here's how the machine worked. A trust would raise $10 million from the public. Then it would borrow another $5 million, sometimes more, using the public's money as the collateral. Now the trust controlled $15 million in stocks. When markets rose, that leverage magnified gains like a megaphone. A good year turned into a phenomenal year. A phenomenal year turned into what people believed was a new financial religion. But the real insanity was not the leverage alone, it was that these trusts began buying each other. Trust A bought Trust B. Trust B bought Trust C. Trust C bought Trust A. A financial Ouroboros, a snake eating its own tail. Each layer built on inflated valuations, each trading at a premium far above the actual assets beneath them. It was a hall of mirrors, and everyone mistook the reflections for wealth. By 1929, nearly 750 investment trusts controlled over $8 billion, a figure almost equal to the entire margin loan market. And at the center of it all stood a name that would echo for decades: Goldman Sachs. The house of cards, Goldman's triple trust bomb. In December 1928, Goldman launched the Goldman Sachs Trading Corporation, raising $100 million. The shares skyrocketed immediately, trading at a premium to the underlying assets. Goldman, sensing limitless appetite, launched a second trust, Shenandoah Corporation, then a third, Blue Ridge Corporation. Shenandoah invested in Blue Ridge. Blue Ridge invested in Goldman Sachs Trading Corporation, and Goldman invested in Shenandoah. It was a perfect triangular pyramid, a structure so fragile that a single shock at the base could shatter the entire tower. And Wall Street loved it. Newspapers hailed the trusts as scientific investing. Radio programs praised professional money management. Banks encouraged customers to borrow against their homes to get in. Meanwhile, insiders at these trusts, quietly, discreetly, were selling because they knew the math, and the math was turning against the world. Stage 2. When the stock market turns into a casino. By mid-1929, speculation was not just a trend, it was a cultural fever. Brokerage offices resembled sporting arenas. People gathered around ticker tape machines like fans around a boxing ring. Every uptick was a cheer. Every dip, a chorus of groans. Secretaries quit their jobs. Factory workers bragged about margin loans. College students skipped lectures to trade. It was the 1920s version of cryptomania, meme stocks, and TikTok trading signals, but turbocharged with leverage. One secretary famously bought 100 shares of RCA at $85 in March. By September, they were worth $420. She earned more in 6 months than in 2 years of wages. Why keep working when the stock market worked faster? This is stage 2 in the 7-stage pattern. Speculation replaces investment. Belief replaces analysis. Leverage replaces patience. And no one, not the public, not the newspapers, not even top economists, wanted to hear that the party might end. The skeptics, the men who saw the storm first. Every bubble develops a small group of early alarm sounders, people who can feel the floorboards vibrating before the building collapses. In 1929, 2 such men stood out: Joseph P. Kennedy and Bernard Baruch. Kennedy, a master of stock pools and market manipulation, was one of Wall Street's great pirates. He understood the psychology of manias because he helped create them. By the summer of 1929, Kennedy began liquidating positions. The famous story, probably embellished, is that his shoeshine boy gave him a stock tip, and Kennedy thought, if my shoeshine boy is speculating, there's no one left to buy. But the truth is more mathematical and much darker. Kennedy understood leverage. He knew that a market based on 10-to-1 margin only needed a 10% drop to wipe out every leveraged participant. He knew that margin calls started. The selling would be forced, not voluntary. He knew that forced selling moves like fire through bone-dry timber, fast, merciless, unstoppable. So Kennedy didn't merely sell, he shorted. He positioned himself not to survive the storm, but to profit from it. Bernard Baruch, older and battle-tested, felt the same shift in the atmosphere. He later wrote that by summer, the air on Wall Street felt charged with mania. Confidence had become religion, reason had become heresy. European banks saw it too. British and German institutions quietly withdrew from U.S. stocks through August and September. Old world financiers had learned from centuries of manias: South Sea, tulip mania, railway bubbles.
They recognized the scent of a market priced for perfection, and they wanted no part in its reckoning. The Fed loses control. Throughout 1929, the Federal Reserve tried, very gently, to cool the fire. They raised the discount rate from 5 to 6%. They warned banks not to lend for stock speculation. But they were powerless, because the real fuel wasn't coming from banks anymore. It was coming from the shadow system. Corporations lending overnight, foreign money flooding in, private lenders hungry for 12 to 20% call loan returns. The Fed was turning the steering wheel, but the car wasn't connected to it anymore. By September 1929, insiders were dumping stock. Trading volume spiked to historic highs. The smart money was already at the exits. And then came September 3, 1929, the peak. The Dow closed at 381.17. It would not see that number again for 25 years. Stage 4. The market leaves reality behind. By early fall, the divergence between fundamentals and prices became absurd. Corporate earnings had already peaked in Q2. Orders were falling. Production was rolling over. But stock prices kept rising. Economists called it the new era. Technological revolution, permanent growth, infinite productivity. It sounded eerily familiar, the same kind of language used in 2000, 2006, and 2021. The most respected economist in America, Irving Fisher, declared, "Stock prices have reached what looks like a permanently high plateau." Those 10 words would haunt his legacy, because October was coming. Quietly, inevitably, mechanically. And it would begin not with a crash, but with a crack. A tiny shift that would trigger an unstoppable cascade. The same crack we see forming again in 2025.
Before the crash of 1929 became a catastrophe, it arrived quietly, like a pressure fracture in a dam wall. The crack, October 24, 1929. Thursday morning, October 24th. The market opened, and something felt wrong. No announcement, no war, no scandal. Just selling. Relentless, heavy selling. Within minutes, the Dow was down 11%, not because investors chose to sell, but because their brokers forced them to. Thousands of margin calls went out. Most people didn't have the cash to answer them, so their stocks were dumped, sold automatically, mechanically, emotionlessly. It wasn't panic, it was mathematics. The ticker tape fell 2.5 hours behind, a fog of war settling over the country. This was the beginning of Stage 5, the moment the machine turns against itself. By noon, the titans gathered. Thomas Lamont, J.P. Morgan, Albert Wiggin, Chase Bank, Charles Mitchell, National City Bank. They announced they would save the market. They bought blue-chip stocks to create a floor. And for a few hours, the system pretended to breathe again. Newspapers declared the crisis over. But over the weekend, tens of thousands of margin calls arrived in mailboxes across America. Come Monday morning, those letters would trigger the next wave, Black Monday, October 28, 1929. The bell rang, and the floor collapsed. The Dow plunged another 13%, a single-day fall that would have been unthinkable a week earlier. But Tuesday would become legend. Black Tuesday, October 29, 1929. At the opening bell, the dam burst. Sell orders flooded the exchange in numbers the system had never imagined. 16 million shares traded, a record that would stand for almost 4 decades.
the Dow fell another 12%. And by the end of the week, the market had lost 1/4 of its entire value. But this was only the beginning of the descent. Over the next 3 years, the Dow would fall from 381 to 41, an 89% destruction of wealth. The great investment trusts, the ones marketed as the future of finance, Goldman Sachs Trading Corporation fell from $326 to $1.75. Shenandoah and Blue Ridge crashed into dust. The Matryoshka Tower of Leverage collapsed floor by floor, exactly as the mathematics predicted. Why the crash wasn't the real disaster? What followed wasn't panic selling. It was a systemic detonation. The crash was merely the trigger. The real devastation arrived in stage 6, the Cascade. Let's walk through what happened. 1. Banks took catastrophic losses. When investors couldn't repay margin loans, banks swallowed the losses. 2. To survive, banks stopped lending. Credit dried up like oxygen leaving the room. 3. Without credit, businesses suffocated. They couldn't buy inventory, they couldn't make payroll, they couldn't survive. 4. Unemployment exploded. 1 in 4 workers lost their job. 5. Bank failures multiplied. Over 10,000 banks collapsed between 1930 and 1933. With no deposit insurance, people lost everything. And the fear fed on itself. 6. Deflation made every debt heavier. This is the killer of all depressions. Imagine owing $10,000 when bread costs 10 cents. By 1933, bread costs 5 cents. Your debt hasn't changed, but the real burden has doubled. Now multiply that across farmers, businesses, homeowners, and banks. It becomes a gravitational collapse, a black hole sucking the economy inward. By 1933, GDP down 30%, industrial production down 50%, world trade down 65%, unemployment at 25%. The global economy convulsed. This was stage 6, the unwinding, and it always ends the same way, in stage 7. The aftermath, the permanent damage. By 1933, the very idea of capitalism was under siege. Breadlines stretched for blocks. Shantytowns, Hoovervilles, sprouted across the country. In Germany, desperation fueled extremism. In America, desperation fueled transformation. FDR launched the New Deal. Social Security, FDIC, SEC, unemployment insurance, banking reforms. These weren't policy experiments. They were emergency stitches to stop the nation bleeding out. And yet, the economy didn't truly recover until World War II forced the largest industrial mobilization in human history. That is the true weight of stage 7. A lost decade, a shattered generation, a social order rewritten. Why this pattern matters in 2025. Because the pattern is not just a story of 1929. It is a sequence, a mathematical progression. And today, in 2025, every stage, from credit excess to speculation, from insider exits to absurd valuations, is complete. Except for one. We are standing in stage 5, the moment before the crack, the moment where everything still looks fine until the first tremor reveals that the entire system is hollow. Let's run through the checklist. Stage 1, easy credit. 2008 to 2022, zero rates, QE, global liquidity flooding, check. Stage 2, speculation replaces investment. Meme stocks, NFT insanity, crypto supercycle, zero-profit companies trading at sky-high multiples. Check. Stage 3. Insider exits. Record insider selling. Buffett sitting on $325 billion cash. Hedge funds building the largest short positions in history. Check. Stage 4. New era thinking. This time AI changes everything. This time rates don't matter. This time deficits don't matter. Check. Stage 5. The crack. This is where we are, right now. The moment before mathematics turns violent. And just like 1929, the system is stacked with leverage, corporate debt, household debt, private credit markets, margin exposure, options leverage, real estate bubbles, government debt at record highs. And all of it depends on one belief: prices will not fall. Because if they do, even a little, margin calls trigger, forced selling begins, liquidity evaporates, and the modern system, faster, more levered, more interconnected, unwinds far more violently than anything in 1929. The part most people miss. The crash won't be your fault, but surviving it will be your responsibility. Because the seven-stage pattern is not prophecy, it is not ideology, it is not theory. It is mathematics disguised as history. A cycle we have lived through 3 times already: 1929, 1989, 2008. And now we are watching the 4th, in real time. The question is not whether the pattern is real. The question is, will you recognize it? Or will you ignore it, like every generation before the fall? Because Stage 6 and Stage 7 never leave survivors who deny the pattern, only those who prepare for it.